Hi everyone, Adrian Player here. This video is for all the commercial property investors out there. I've just driven into Sydney from the Port Macquarie region to do a podcast with Steve Policey Property for all their commercial clients. We've just done a live webinar with 200 plus commercial clients, and there will be a podcast and a webinar that I'll be posting on my socials shortly. In this video, we're going to be talking about all the commercial clients out there that have secured their deals in the last 12 to 18 months, and the rates have shot up, right? So a lot of these deals were getting done in the majors, especially the lease stock deals, all right? But since the rates have gone up 3 times, a lot of these deals now have to be done in the mid-tier banks on a slightly higher rate. So we're going to be going through this checklist, and this is the process that we're following based on, what we would be doing to get your rates on a better rate and when would we be refinancing and why. Now, just bear in mind that with refinancing, it's based on the loan size, it's based on how many properties you've got, it's based on your LVR as well. So if you're comparing rate ranges at 70% LVR versus 65 and 60, it's very different, because if your LVR is lower, you should be on a sharper rate. And also, if you've got 2 or 3 properties and you've got debt levels, in the realm of $2, $3, or $4 million, you're going to get a much better deal than others, right? So let's go through these items. Now, a lot of these items affect lease stock clients a lot more. So let's explain what lease stock is. Lease stock is focusing on only the deal. So we isolate it in a specialized vehicle like a corporate trust or a company, right? And then what we do is we look at the deposit and costs and the rental yield and the lease. That's it. So the deal services by itself. So the rental income is one of the large requirements for the borrowing power to work. And in the majors, the interest coverage ratio, or the ICR, is a 1.5 times, right? So that means that the rent needs to cover the interest-only repayment by 1.5 times for the deal to work. So a lot of these clients have been pushed into the mid-tier banks to get their deals to work after the rates have gone up. So there's a big chunk of clients sitting in these banks that, unless the rates come down or unless they lodge a really good tax return where their income goes up and we can move them over to a full doc borrower, they're stuck at the moment on higher rates. So this is the process that we would discuss and talk them through to get them on a better deal and discuss how these kind of things work, right? So let's go through the list. So 1, buy gets done in the mid-tier banks to secure the deal, and a lot of the time the rate ranges at the moment, depending on the risk assessment and the LVR, is anywhere around a 6.9 to maybe a 7.1% range. Why are the deals getting done there? Because these kind of banks are the best mixture of interest rate and borrowing power on the market at the moment for lease stock and full doc deals, right? So like we talked about, the ICR, interest coverage ratio, is a 1.5x in the majors, and it's a 1.3x in the mid-tiers. So you're juicing up the borrowing power by going into the mid-tier banks. So then 3, so there is more borrowing power to secure the commercial property. So you've secured the asset, right? Now the rate range is like we talked about, it's 6.9 to about a 7.1, depending on the amount of loan size, the LVR, and which bank you've picked in the mid-tiers. It'll be somewhere around there, depending on the risk assessment on the deal. Remember, there's no carded rates in commercial. They do a risk assessment on the deal, and then they want to make a margin on top of that. So every deal is different. So then number 5, secure the deal. Now what? Well, we refinance, but there's a lot more costs with commercial than there is in residential. There's an app fee, which can sometimes be up to 0.5 or 0.6%, which is quite high, as well as valuation cost. And that could be in the realm of 2, 3, 4, 5 grand, depending on how big the asset is and how specialized the asset is. And a lot of these costs are impacted on you before you even know if the result result is going to work. Now, the lender's going to sit there and they're going to check the borrowing power to make sure that works. But what if the valuation comes in short? Then suddenly you're out of pocket and you paid for a valuation cost. Half the lenders don't pay for it themselves. It comes out of your pocket. So you better be very confident that your property is valued up at where it needs to be for your refinance to occur. And a lot of the time that happens around a uptick in the rent on the lease renewal, or you get a market appraisal and they think that it's gone up a lot. But a lot of the time you have to know that there is a very decent sized buffer there, because if it's not, you're going to incur costs and then you're not going to be able to move it across. So that's why, in residential, everything's quick, efficient and easy, and everything in commercial is slow and clunky. And this video is actually directly for my client Terry that I was speaking to today. I won't say his last name. So hopefully this kind of video helps, right? So, yeah, you've got to make sure that there's enough buffer on the deal, right? Because you don't want to incur costs and then not be able to get the refinance through. All right, so what else? So the rate differential needs to be high for it to be worthwhile to refinance. So that's why you see a lot more clients staying for 18 months to 36 months most of the time in commercial, and then we move them to a major, or they buy their second property, then we move them to a major. So that happens a lot, right? So first, number 7. So first, we email the current lender with a competing rate offer and ask them to match. So if you do as many pricing requests as I do on a monthly basis, we know which lenders are sharp, which lenders are aggressive, what is the sharper rate that they've got, and what you're most likely going to be offered. And then we send that through to the current bank to see if they'll match it or drop the rate a little bit to help you out. So that's the first step. Number 8, then if that doesn't work, we wait for the rates to drop, or a lease renewal, or a rental income uptick, or maybe you've lodged a tax return where your income's gone up, maybe a self-employed person, and now we don't need to do a lease doc loan, we can do a full doc loan. Or some people might sell 1, 2 or 3 residential properties, clear some debt, and now we don't need to do a lease doc deal, we can do a full doc deal, which means that we can move you back to a major. All right, so these are the kind of things that we need to talk about. And then number 9, so the ICR will work in a major, or we lodge the new tax return and the income goes up, and then we can move you over to a full doc deal, and then that allows us to get you into a major on a better rate. All right, then we shop it to 3 or 4 of the major banks and have them compete on rate and fees, and then that gets presented to you. And then once you've got that, we can get you over to a major and get you onto a much better deal. So hopefully these kind of concepts help you as a commercial investor. We are premium in a lot of the major banks, which means we do a hell of a lot of volume in the commercial space. We deal with commercial bankers that have sharp pricing, that have the right delegations and experience to tick off their own deals. And also they all do volume, so they're very confident on what kind of pricing and rate and fees can be offered. So we've got all our preferred bankers in our main cities. So if you need me to do this for you, my email address will be in the description box on YouTube, or also on TikTok. You can go to my profile and my email's there, adrian@integralloansolutions.com.au. More than happy to help. We do a hell of a lot of commercial lending, and these are the kind of things that we talk about with our clients, so they're fully aware. And look, we just don't like churning our clients 24/7. We like talking about the pros, the cons, and the timing, and making sure they're aware of what the next steps are. All right. Also, we don't want to be sending clients through to second-tier banks on really sharp rates, because if you're going to be a client that is buying 2, 3 or 4 commercial properties, the major banks, the big 4 banks, don't want to go second second security, second director guarantee, second GSA, second caveat to a mid-tier bank. So a lot of people chase these mid-tier banks on these sharp rates, but then, as soon as you want to buy your second or your third property, I've got to get it done in the majors, and you should have been there from the start. And then the discount that you got on the really low rate and fees gets eaten up when I've got to refinance you back to the majors, and then you've got costs for doing so. So this is why we need to be discussing these kind of concepts, and I hope these kind of videos help commercial property investors a lot, and we'll see you on the next one. All right then, take care. Bye.